people to actually refinance and take advantage of these gains. One of the points that we want to make in this paper, though, is that any intervention that you might do that might increase the likelihood that an individual's refinance when gains arise will change incentives for banks at origination. In a sense, we think of mortgages as long-term contracts with one-sided commitment. Banks cannot raise interest rates in the world where rates go up after the contract is signed, but borrowers can refinance and switch banks whenever rates fall, right? And as a result of this, of course, you know this, banks face refinancing risk and account for it when pricing. And now, if we do an intervention that makes it easier to refinance for particular subpopulations in a country, there's a question about how much of those gains will be undone at origination. And we feel like this question is open, and we're going to try to tackle it in today's paper. So our main research questions are: which information frictions affect this market and for whom? How do information interventions attack these frictions? Do they change, the likelihood that individuals search for refinancing quotes? Do they change the likelihood that individuals successfully refinance? And then what does that do to equilibrium outcomes? And when I say equilibrium outcomes, I'm going to mean both equilibrium in the refinancing market and equilibrium in the origination market. So how are we thinking about this refinancing inertia? What stops borrowers from refinancing? In our reading of the literature, we identify four main forces. One is lack of awareness, inattention, and this is there's some people out there who are just not paying attention to rates this period, who may not even know about the possibility of refinancing. I'll show you some survey evidence on that, and that certainly is a barrier for refinancing. The second is beliefs. It may be the case that borrowers underestimate the gains they will receive should they refinance. And in that world, there's no sense of initiating search and doing a whole costly process if you do not believe that you're going to get anything out of it. There could be search costs. It could be the case that, even once consumers initiate a search, they fail to fully search throughout all the banks that could offer them a refinancing quote. That one may lead them to have lower refinancing savings than what they actually would have if they fully searched. We also find in our data that sometimes when consumers search, the only place they search is their home bank. And the home bank knows that there's a probability this person will never search again, and thus has incentives to just reject the refinancing offer. I'll talk a little bit more about that in the context of Chile, because I think that's actually quite interesting. So I'll discuss this when we get to the results. And finally, there could be switching costs. The whole process of, even after you get a quote that you think that actually will save you money, the process of refinancing is a hassle. This is particularly true in a Latin American country where there's quite a bit of bureaucracy involved. And beyond that, borrowers may just value their home bank, perhaps because of tie-ins to other accounts or simplicity. All of those things could generate frictions for refinancing. So you attack any of these frictions, and the second you do so, that's going to lead immediately to lower profits for the home bank when rates fall, right? Rates fall. In the status quo, some people are not going to refinance. Now you treat them, you induce them to refinance, marginal refinancers, if you will. That lowers profits for the incumbent bank. And immediately, when you take a step back at origination, that's going to give you an incentive to increase rates. And now the question is, okay, you are inducing some marginal respondents by trying to lower refinancing frictions. The bank ex ante at origination does not know who the marginal respondents are, but they do know the intervention is happening. Now they're going to raise rates at origination, and now you have a distributional impact of your treatment, right? People who are induced to refinance because of your treatment have a differential benefit from the treatment than people that are not induced to refinance, or than people that were going to refinance anyway. Both of those groups have the same refinancing action, but they face higher rates at origination. And correlation with observables such as income or other demographics may make this very important and salient for policymakers. So that's how we're thinking about this. What have we done so far? We've run a failed experiment. We've partnered with the largest bank in Chile and implemented interventions through an informational treatment aimed at reducing these frictions. I'm going to show you the direct effects of these interventions. Our main outcomes are going to be search. Do you go ahead and look for quotes? And do you actually refinance? In the paper itself, we have heterogeneity analysis as a function of potential gains, income, age, and your baseline beliefs. I'll talk a little bit about that today, but I don't think I'll have time to get into the details. And then we've estimated a model, structural model of demand and supply for mortgage refinancing with information frictions. We want to do two things with this model. The first is we want to get at the equilibrium implications of reducing information frictions. The way we implemented our field experiment, we treated a substantial fraction of the Chilean mortgage market, but we do not believe that banks took that treatment into account when making these individuals offers. As a result, what we observe is not actually the equilibrium outcome of reducing information frictions because banks did not reoptimize. So we're going to use our supply side model to say, okay, how would banks reoptimize if the demand behaved as if we had permanently implemented our interventions? That's the first thing we're going to do. The second thing we're going to do is we want to use the structural model to make a comparison between the informational interventions I just discussed and much larger reforms. Our info treatments are basically delivered via email by a government agency. Simple, inexpensive to do. We want to compare the effects of these treatments with the effects of reforms that are out of sample, expensive, difficult, like, for example, implementing a mortgage exchange. We think that the structural model there is a really useful tool because it's going to give you a sense of how these two interventions compare before you go ahead and pay the fixed cost of actually implementing a large-scale reform. And finally, our long-term goal, as I discussed earlier, is documenting how much spillovers there are from the refinancing market to the origination market. I don't have that for you today. Unfortunately, we're working on it, but I hope that when you guys see the next draft of the paper, you'll get a chance to see that. So before I move on, are there any questions from the audience? Okay, well, let me keep going then. Just as a preview of results, we're going to show you that information frictions, in fact, play a role in the lack of refinancing that we observe in this market. We can, through our informational interventions, increase the likelihood that individuals search for mortgages. We can also increase the sensitivity of the probability of searching with respect to gains from refinancing. That is, when we tell people that they're going to save more if they refinance, we can get the people that we tell them they will save more to actually search more. We're finding that biases in borrower beliefs about gains from refinancing seem to be the main friction that's going on here. We get very limited effects on refinancing. We basically get a bunch of noisy zeros. So while we induce people to search, that doesn't actually map to refinancing itself. This is because 2 weeks after our intervention went to the field, the Chilean central bank doubled interest rates. And as a result, most of the gains that we had calculated prior to treatment were dissipated by this. We got a very bad negative COVID shock here. So what we're going to do when we go to the structural model is use the model to say, okay, we have from the experiment a mapping from treatment to search. We have in the pre-period a mapping from search to refinancing. If interest rates hadn't gone up and the map from search to refinancing had stayed the same, what would have been the impact of the experiment on refinance? And then I'm going to talk about two counterfactuals. First, we find that lowering frictions, all of them, increases monetary policy pass-through, but differently across frictions. So it's how monetary policy passes through and who benefits from a drop in interest rates differs if you are targeting lack of awareness or if you're targeting search costs. We find that our full treatment increases refinancing and lowers rates similarly to an exchange. So in the interest of time, I'm going to skip our. Go ahead. Yes, please.
Just a clarifying question. This is Luis.
Yes.
You mentioned that refinancing, if the informational structure that people have or the search structure that they have affects how likely they are to refinance, then this will cause changes in the banks because,
Yes.
banks design their origination based on some expectations on refinancing probabilities. Is this, so it's not clear from the preview of results, is this something that you're also looking at directly? Or
yeah, so this is something that we're,
side?
No, this is great. Thank you for that. This is something that we're working on right now. Like I said in this slide, today I don't have what happens and how much this spills over to the origination market. So everything I'm showing you in terms of, I will show you in terms of counterfactuals are results solely for the refinancing market. So we're going to allow banks to change pricing at the refinancing stage, but we're holding origination fixed. So you can think of our results as being the results for people who got their loans prior to a large scale reform, but that went to refinance after the reform, right? And what we're missing is the piece, okay, but what's going to happen to people who go to originate after the large scale reform? Does that make sense?
Luis, you're still muted.
Okay.
Sorry, there's two hands raised. So if it's okay, since you stop for clarifying questions. So we have Yunji and James. Yunji, you wanna unmute and ask a question?
Yeah. Can you hear me well?
Yes. No.
Okay.
Yes.
Thank you. Hi, my name is Yunji. My question is related to Louis' question just now. It's about the spillover. I know that this is like beyond today's presentation, but when you first showed us about the prediction of how the bank at the origination, they're going to react, I thought they could be like, it really depends on how much of the bank believes that borrowers believe about the refinancing benefit. So if they believe that they can sort of beat, knowing that there's a search cost, if they start their origination rate lower than current situation, maybe it could compensate sort of the search cost. Whereas if they believe that the refinancing benefits like so huge, then bankers' incentive would be set up the rates at the higher level at origination. So I think there's like this sort of depending on how the bank perceive about the benefit of the refinancing of the borrowers. So can you walk us through a little bit about like the potential bank's reaction at origination?
Yeah, that's great. Thank you for the question. So the way we think about this is at origination, there's going to be a state variable, which is going to be the current interest rate curve. And banks are going to have some expectation about how interest rates are going to evolve in the future, right? So given today's state of the world, that's going to induce a probability distribution over the likelihood that rates are lower than at origination, right? Or in general, how rates are going to evolve. Now, time is going to pass, and as time is going to pass, when individuals land in states of the world where, one, they're aware, and two, rates are actually lower, they're going to initiate search. Just exactly like you said, people are not going to initiate search after an epsilon drop in interest rates, because in that case, it's not going to justify paying the search cost, right? So the drop in interest rates has to be substantial enough, and the length of the remaining time in the mortgage contract also has to be long enough for people to want to pay the search cost and start getting draws. That's exactly how we see it. So you're right that there is a discouragement effect that comes when you lower your interest rate at origination, because that increases the likelihood that the search cost wedge is enough to discourage search, right? But that's true prior to treatment when the search cost exists, and that's going to be true to a lesser extent when after treatment search costs drop, right? But I agree with you that the key primitive here is the change in search costs induced by treatment.
Thank you.
Thank you. James?
Hi. I wanted to ask about, I guess households can make refinancing mistakes, in both directions, right? So they can refinance not often enough, or they can refinance when it's not optimal for them. So I guess I wanted to ask if that's an issue in this setting, and I guess in particular, given the rise in rates that happened, just as you implemented the experiment, that, would it actually have been optimal for these households to refinance? If you'd seen a big effect on refinancing, would that actually have been welfare reducing?
Thank you. So it is certainly possible for you to refinance suboptimally. And that can happen in one of two ways. One is you can refinance too soon. Interest rates are dropping. You refinance at the beginning of the interest rate drop rather than at the end of the interest rate drop. That does not happen in this case. We do the treatment after, exactly at the end of a years-long drop in interest rates in Chile. I'll show you that slide in a few minutes. So we're not too worried about, or not worried at all about, that mistake. The second mistake is people who refinanced after interest rates spike. We gave them information before the spike, and they made decisions after the spike. So that could have been a concern. This is the place where, from a moral perspective, it's really nice that we don't have a change in refinancing rates relative to the control group. So that doesn't seem like we induced mistaken refinancing here.
So I guess what I'm asking is, given the increase, maybe you'll show it later, but what was the distribution of the refinancing gains, following the rate spike? Were there actually still a lot of households for which the refinancing option was a long way in the money, or not
There
really?
There were some. I don't have that graph. There were some, but not very many. Not very many. And the other issue, and one that we're still trying to work through, is that there's also a bank rejection side. Right? There was a lot of uncertainty in Chile right after the interest rate spike, and for a couple of months, not much refinancing was happening. So it's not clear to me that someone who had a very, very high interest rate and who would have still benefited from refinancing would have been, in fact, been able to do so. Okay, great. In the interest of time, let me skip the related literature. I think I've made our contribution sort of clear. Let me tell you a little bit about the setting. We're looking at, as you know, mortgages in Chile. Mostly, these are 30-year contracts, some 20, some 25-year contracts. The overwhelming majority of contracts here are fixed-rate contracts. And there's 15 national banks. In terms of refinancing, there is a prepayment penalty here. It's 1 month of interest over the prepayment. And in the data, we find that most of our refinancing, again, the largest proportion of the refinancing is associated to rate reduction rather than to equity extraction. There's a really interesting regulation that was implemented a couple of years before our treatment, which really helps us out, which is the Chilean government implemented something that's called a portability regulation, where essentially if you want to get quotes from another bank for your mortgage, all you have to do is go to the website of the other bank, input your national ID number, say that you are interested, and now this new bank can ask your home bank for all your information about your mortgage. Home bank has to respond within 24 hours, and the new bank has to respond to you with either a rejection or an offer within a couple of weeks. So this is very useful for us because we have access to the requests data. So every time a consumer goes to another bank, puts their national ID number on the website and asks for a quote, we see that. I'm going to call that search. And we think this is something rather nice from our setting. We actually get to see who and where they are searching for quotes. We've partnered with the largest bank in the country, the state-owned bank, Banco Estado, for our experiment. This is the second largest mortgage lender in the country. They have a 20% market share. We accessed the portfolio of 230,000 borrowers. It's basically every borrower affiliated with the bank that has an email address. They, on average, earn $1,500 a month. They own roughly roughly $70,000, and 5% of that debt is in a mortgage. So first, let me show you that refinancing is low, despite the fact that interest rates have declined over time. So on this graph, I've got on the x-axis the interest rate, and on the y-axis just the probability. Light blue is the loans that were originated in 2010. Dark blue are the loans that were originated in 2019. The thing I want you to take away from this plot is it really seems like the support of these two distributions don't overlap significantly. That is, even the safest borrowers who originated in 2010 received more expensive mortgages than even the most expensive, riskiest borrowers who originated in 2019. And as a result, there are clear incentives to refinance in the period between 2010 and 2019. Despite this, we see that only 6% of all total originations in the country are refinancing. This is opposed to between 20 and 70% of the United States, depending on the time horizon. And in our data, only 0.5 percentage points of borrowers refinance in a given year.
Gaston?
Yes?
Do you want to speculate why refis are so much rarer in Chile than the US? Is it the 1 month
Yes.
payment
Give
penalty?
me a second, and I'll get there for sure. So first, let me show you a little bit more. Here on the x-axis, I'm plotting what our prediction is about the potential gains from refinancing. And on the y-axis, I'm plotting the share of borrowers that actually search for a bank. This is data from our control group. You can see that there is a slope. It is true that people who have higher gains from refinancing actually are more likely to search, but search probabilities are still quite low. Even for the people with the highest potential savings, if you're poor, that probability is about 0.5%. And if you're rich, that probability is only about 10%. On the right-hand side, I'm showing you actual refinancing, and you can see that the slope is much shallower and the magnitudes of the probabilities on the left-hand side are much lower. So the probability of refinancing for people with the highest potential savings for refinancing are only about 0.1%. For the richest, it's more like 0.4, 0.5%. So while borrowers are responsive to gains from refinancing, and high-income borrowers search and refinance more often, we find two things. First, there's obviously a search friction. right? The search probabilities are not 1. They're nowhere close to 1, even for people who have very high gains from refinancing. So that's one source of the refinancing friction. The second source of the refinancing friction is that even conditional on search, the likelihood that you actually refinance is quite low, and you can get that from the difference in the magnitudes of the y-axes across these two graphs. So it can't just be search costs. Switching costs and rejections must also play a significant role here. We ran a survey prior to our treatment to get a better sense of why people were not refinancing. On the left-hand side, I'm showing you the responses for have you ever attempted to refinance? I want to highlight that 60% of survey respondents never attempted to refinance, and roughly 10 or 12% of them said yes, but we got rejected. And another 10 or 12% of them said yes, we tried, but we didn't get any better offers. These are going to be important frictions in the market and important frictions in our model at the end. In terms of reasons for never attempting to refinance, the largest response here is we just don't know how this process works. That's about 25% of individuals. There's also a satisfaction with the current bank that speaks to switching costs, lack of time, which speaks to search costs. I'm uncertain about whether I'm going to get approved. I didn't even know refinancing was a possibility at all. That's roughly 12% of survey respondents. When you zoom in on that response, you see that that response is particularly concentrated on the poorest people in our sample. So I think between the evidence I showed you last slide and the survey evidence here, I think it's pretty clear that there's several soft barriers to refinancing. Some of them are search costs, but there's more than that. There's beliefs, there's switching costs, there's the likelihood of being rejected, there's a home bank advantage. We're going to incorporate all of that into our analysis later.
Could I ask, is there like a learning issue here in the sense that, is it the case that maybe the mortgage market was small, or that there haven't been that many refinancing cycles where, you know, people could really have the opportunity to refinance previously, or you know, I mean, households have gotten, you know, more efficient at doing this in the US over time, and part of it I think is just learning, right? Is that, you know, is that what's the status of that in this case?
That is a great question. So there's been a significant growth in home ownership in Chile between the late 80s and now. Home ownership was much rarer prior to the late 80s, or home ownership with substantial mortgage debt, I mean. So there is certainly a population for whom this is maybe either their first or perhaps their second mortgage. That is going to be highly correlated with income. And to that extent, I guess it doesn't surprise me as much when you frame your question that way, that many people in this group are saying, I didn't even know refinancing was a possibility. So I think, yes, lack of familiarity with the system and lack of financial education is a huge problem in Chile more broadly. So that is certainly a potential friction. I don't think that this is an important barrier once you climb higher in the income gradient. And I showed you that the wedges were there for richer people too. Those individuals are aware of this, and the market is sophisticated in that sense.
Thanks.
Thank you. Okay, so we have data on the mortgage market, which is a combination of data from Banco Estado, our bank partner, and the commission that monitors financial markets in Chile, which is called CMF. This is the regulator. So we have basically perfect data for the stock of all outstanding mortgages, the flow of all originations, loan terms, performance, borrower demographics. We can match it at the individual level with data from search. This comes from the portability regulation I described earlier. So every time a consumer goes into the website of either our partner or rival banks and asks for a refinancing quote, we get that information recorded. We also ran 2 surveys, a baseline survey 6 months before the intervention to get at these barriers to refinancing and beliefs, and a follow-up survey a month plus after the intervention, where we asked people about their refinancing plans. Let me walk you through our experiment. So again, our sample is the 230,000 mortgage borrowers from our partner bank. We implemented 6 treatments. Treatment 0 is a control group. Treatment 1 is a treatment that is meant to only shock awareness, just meant to make you aware of the possibility of refinance. Treatment 2 is a treatment that beyond increasing your awareness is also aimed at aligning your beliefs. Treatment of how much you would save, I'm sorry, if you were to refinance. Treatment 3 is aimed at reducing your search costs. Treatment 4 is aimed at reducing your switching costs. We have a full treatment that does 1, 2, 3, 4, and 4. Every treatment is delivered by email from the Consumer Protection Bureau, or called CERNAC here. So we don't send the emails. CERNAC sends the emails. CERNAC sends quarterly information statements to consumers about their outstanding mortgage debt. So it is common for consumers to receive this information via email. And we were asked by CERNAC to make our email treatments as similar to the actual information consumers get as possible. Through CERNAC, we can verify email reception and opening. Let me show you a little bit more about these treatments. Nope. Okay. So treatment 1 is our awareness treatment. The top half of the treatment is literally the same information consumers get every quarter from CERNAC. The only difference between their current statement and the experimental statement is this box right here, where all we do is tell them, hey, did you know you could refinance and potentially reduce your monthly payment? Okay, that's treatment 1. Treatment 2 combines the previous information, the box I mentioned before, with a thermometer describing how much consumers would save if they were to refinance. So the thermometer highlights the current rate the consumer is paying, our predicted rate for consumers like them in the market. The thermometer also tells consumers how much they would save annually and in total if they were to refinance. That's treatment 2. Treatment 3 is meant to reduce search costs. Beyond the awareness treatment here, we also walk individuals through exactly how you should search for a new mortgage, how you can get quotes from different banks, and how to compare the value of different quotes. We point them to a website that is constructed by the Chilean banking regulator, where where average interest rates for people with the same observables as them are reported for every single bank in Chile. This is meant to better guide search. Treatment 4 is our switching treatment. Here we walk people through exactly how the portability regulation works. We tell them step by step how you can go from requesting a new offer or to actually refinancing. Try to make the process less opaque and make timelines clearer. I'm sorry, I think someone is unmuted and please ask them to mute themselves. That's treatment 4. Treatment 5 does everything. So these 4 treatments combined. Okay. Let me show you our
that's on
predicted
all the other treatments that you listed up until 5. It's a separate treatment, and then 5 combines all of them.
That's exactly right. Except just for subtlety, notice that the awareness treatment is there everywhere. We didn't want to get into, we don't think we had the power or really, we didn't want to spend power trying to determine the difference between awareness like this and awareness like this. So you can think of the difference between 1 and 2 as just the change in beliefs, not also a differential effect on awareness because this one has colors and the other one doesn't. In terms of measuring gains from refinancing, the distribution here answers a previous question. This is the difference between current rates and predicted rates prior to the interest rate spike. So we see that 90% of borrowers would have gotten a lower rate upon refinancing, according to our model. This would have been savings of about $4,000, which is roughly 3x monthly income, 13x monthly payments in mortgages. And of course, this got severely truncated after the interest rate increase. Our main spec is very simple, intent to treat specification. Nothing too sophisticated here. We're estimating this we stratified treatment by observables. So we include strata fixed effects. What I'm going to report is the treatment effect of sending the email. Our email opening rate is 50%. So if you want the IV for actually opening the email, you should just multiply the coefficients I'm about to show you by 2. So first column in this graph is just do you search. Our main result is that all treatments increase the probability that an individual searches from between 7% for our least effective treatment, which unsurprisingly is the awareness treatment, to 25% for our most successful treatment, which again, unsurprisingly, is the full treatment. You can see, though, that the beliefs treatment and the search treatment have kind of similar magnitudes, although they are targeting very different behavioral frictions, and that the switching treatment is slightly less effective than that. Second column just shows the space in terms of the number of searches rather than do you search. Okay. Yeah, nothing major here that I want to talk about. In the paper, we have a little bit more time. We show you that our treatment effects are strongest for the borrowers that have the highest gains from refinancing. They're also the strongest for borrowers that reported more pessimistic beliefs at baseline, and they're strongest for high-income young borrowers. But we have limited effects on refinancing. On the left-hand side here, we're showing you survey responses for do you have plans to refinance? And you can see that in the survey, individuals did tell us that yes, they did have plans to refinance. But when we actually look at the data and look at whether these people actually refinanced, you can see that we have very tight zeros here. So no actual effects on refinancing. Where is this coming from? Well, this plot shows on the x-axis time, and then in blue, the average interest rate, in black, the funding rate. You can see that funding rate spiked right after intervention delivery. This plot gets even more dismal if you add 2023. The funding rate is well more than double the funding rate at the end of 2022 today. So it's unsurprising then that we didn't have much effects on refi. Yep.
Then you mentioned the large refinancing gains just a couple slides before. Those were measured before the spike in interest rates.
Yes, those were measured.
Right. And so can you, I guess if you have the details about each individual mortgage, can you measure whether the probability of refinancing or the change in the probability of refinancing conditional on having positive gains? I guess it varies, right, across all the mortgages depending on what interest rates they had locked.
That's a good question. I have not looked at the change in refinancing conditional on positive gains. We should do it. Now, the population is changing, right? The population with positive gains before the spike is naturally quite different than the population after the spike, right? There's a question as to whether that comes from
Right.
risk or whether that comes from just these are the most inattentive people. But we should take a look at that. Thank you.
But
Thank
but
you.
there are, yeah, the population is changing, but there are, of course, those that were subject to your treatment and then that stay in the sample.
Yeah.
Okay.
Yeah, and that is true, and that is balanced between treatment and control. So that's a great question. Thank you. I suspect that the answer is going to be even with positive savings, these people are not refinancing, and that's going to come from a bank rejection channel. But it's important to document that. Thank you.
I was going to say, I mean, when you have like a null result like that, I mean, maybe you should try and frame it in terms of what you can rule out, right? Like, I mean, you do have some refinancing, at least based on the constant term, right? It's like
Yes, but
6.6%. So
no,
if
no,
I'm reading it right,
that's multiplied by 100, I think.
okay.
Yeah, so it's not a 6% refinancing rate.
Okay. Well, I don't know. So I mean, whatever it is, right? I mean, you should be able to say something about, what's the proportionate effect on refinance. Like, we can rule out the point estimate for the full treatment is negative, right? So, it would just be helpful if you could sort of say like, we can like our confidence band, says that the proportionate effect on refinancing was less than 30% or whatever.
No, thank you. That's a great point. Thank you. Appreciate it. Okay, so taking stock, we have documented that these information frictions I've been discussing do play a role in the lack of refinancing. We have interventions increasing search. These interventions also increase the sensitivity of search with respect to games. We have no effects on refinancing, though. We think that this is due to the rate increases. We have evidence that effects here are operating through beliefs. First, treatments that inform borrowers about gains are the treatments that have the strongest impacts. And second, pessimistic borrowers, according to our baseline survey, are the ones who are the most likely to respond to treatment in search. There are several open questions. The first is obviously what would have happened if the interest rate spike had not happened? What would have been the supply side response there? If you had done alternative policies to target information frictions, what would have happened? For example, if you implemented an exchange that essentially lowered search costs to zero, what would have been the equilibrium outcome of that? Both for these alternative policies and for the policies in sample, what are the implications for pricing and for pass-through the refinancing market? I'm going to talk about these three things now. And the final missing part is for each of these policies, what would have happened into the origination market? And like I mentioned earlier, that's for future work.
Gaston,
Let me walk you through.
and maybe
Yes,
you will
please.
maybe you
Go
will
ahead.
describe it in your counterfactual. But when you say an exchange, what is the structure of an exchange that you have in mind here?
Yes, I will talk about it, but happy to talk about
Okay.
it now as well. I am thinking of a mechanism through which when consumers become aware of refinancing, of the refinancing possibility, instead of having to go bank by bank looking for quotes, they just go to a centralized system, and the centralized system inputs their information and tells all banks in the market, hey, this person is interested in receiving refinancing offers. And then the banks bid on them. This is actually exactly the structure for the purchase of annuities in Chile upon retirement. So it would be replicating the annuity exchange Chile already has for mortgages. So let me walk you through the model. So there's going to be a demand side, there's going to be a supply side. Today, in the demand side, we're going to take bank choice at origination as given. That endows each borrower with an interest rate, a term length, and a borrowed amount. Every year, we are going to model individuals as making the decision to refinance or not. And the model is going to involve the following 4 steps. First, there's going to be inattention. Not every borrower is going to be making decisions about whether to refinance or not. So some consumers are going to wake up every period. Consumers who wake up go through the process. Consumers who do not wake up do not refinance that period and the period ends. For consumers who are attentive, they're going to first decide whether to initiate a search for refinancing offers. When they initiate a search, they're going to pay a baseline search cost. Then they're going to construct consideration sets for banks. Every time they want to add a new bank to their consideration set, they're going to have to pay a per bank cost. Having initiated a search and constructed a consideration set, they're going to obtain quotes and they're going to choose the most attractive offer. Consumer behavior here is going to depend on your current contract, on market conditions, and it's going to depend on information frictions. Which frictions? Lack of awareness, search costs, costs of adding more banks to the choice set, and then once they get offers, switching costs. In terms of supply, banks are going to be forward-looking. Every time someone asks them for a quote, they're going to trade off short-term profits of giving them a better offer with future refinancing risk. And they're going to have market power. Where does market power come here? It comes from the information frictions. If you're the home bank, there's several sources of market power here. The first, obviously, is that some consumers don't wake up. Because they don't wake up, you get to charge them higher rates than rates you could have charged them had they tried to refinance. Second, some consumers, even when they're awake, they're not going to initiate search. That also gives you the ability to extract rents from them. When they initiate search, some consumers are only going to search with you. We see this in the data as well. And that also gives you market power over these consumers. You're not competing against anyone. And then that's a stark corner example, but as the cost of growing the consideration set of banks increases, that decreases competition for the home bank, and actually also for all the other banks in the consideration set, enabling them to extract rents too. Good. That's the gist of the model. Let me walk you through our main results. We have 5 frictions here. The first is awareness. Here, what we're presenting on the blue column is the probability that a consumer is inattentive or not aware. So you can see that we're estimating that in the control group, 4% of borrowers are awake every year. And you can see that our different treatments actually increase this probability of awareness significantly. The biggest awareness changer is the search treatment, but actually with standard errors, these are all quite similar. The second column shows you bias. This is an estimate of biased beliefs relative in terms of basis points. So what's the difference between the rates that you could get in the market and your belief about the rates that you will get in the market prior to initiating search? We find that borrowers are pessimistic on average by 48 basis points, but this has a distribution. The quartiles, and it's quite spread, quartiles between negative 80 basis points and 180 basis points. We find that low-income borrowers have higher pessimism than high-income borrowers. In terms of search costs, in the control group, we're estimating that consumers act as if initiating a search costs $8,900. All treatments decrease this. In particular, the switching treatment, the full treatment. We also find that high-income borrowers act as if they have significantly lower search costs than low-income borrowers. In terms of per bank search costs, there's not that much action across treatments here. We're estimating that consumers or borrowers act as if obtaining an additional quote costs around $1,500 per bank. And finally, we're estimating switching costs of about $300. This is on top of the interest cost penalty that comes from refinancing. These $300 are about half of the interest penalty from refinancing. Okay, now let me walk you through our main counterfactuals. So as I started, our main question of interest here was, how do information frictions affect equilibrium outcomes? We're going to compare the baseline scenario to two counterfactuals. One is full treatment. So we give everyone in the market treatment 5, but we also allow banks to know that consumer demand primitives changed to those of treatment 5. So we allow banks to reprice. We're also going to compare the baseline to implementing a refinancing exchange. How are we going to implement the exchange? We're going to reduce the search costs kappa and S, and we're going to leave other frictions unchanged. You may say, hey, Gaston, but perhaps the mere act of setting up an exchange changes awareness, and I'll show you additional results for sensitivity analysis where we actually change the awareness to. I don't think I'll have time, but we also have results for how do information frictions affect monetary policy pass-through. So what we're going to do is, for a given state, and that is a combination of current interest rates, remaining period in the loan, and the borrowed amount, we're going to solve for counterfactual search and refinancing probabilities and average interest rates at the, when the period ends, under the counterfactual distribution of frictions that we just estimated before. And today we're going to focus on a borrower that has a 6% rate and 20 years of maturity remaining in the loan and a relatively high balance. So everything you see is going to be for a person like this for today. So two plots here. On the left-hand side, we're plotting the probability of refinancing. On the right-hand side, we're plotting end of period rates. Baseline is our prediction for what the control group would have done in a year had the interest rates not spiked. So we're estimating a refinancing probability of roughly 1.8 percentage points. Green is what would have happened according to our model under full treatment, treatment 5. That is, if we've given everyone treatment 5, we're finding a refinancing probability of roughly 3 percentage points. So we almost double the refinancing probability under those assumptions. I think really interesting is to compare green to the 3 bars to the right, which are what happens if you implement a refinancing exchange or a mortgage exchange. You can see first that if you implement an exchange, and in black in this graph or gray, we have the assumption the exchange reduces search frictions by 50%, and in blue we have the assumption the exchange reduces search frictions by 100%. And you can see that for both cases, actually the exchange has quite similar effects to the full treatment, despite the fact that full treatment is just sending an email trying to align people's beliefs and give them more information about the market. We find this quite surprising and quite interesting. It seems like the informational treatment is much more cost effective than the large scale reform under this assumption. Now, of course, if the exchange, beyond reducing search frictions, also drastically increases awareness, that result flips. You can see that if it reduces the probability consumers are inattentive by 15%, then the exchange significantly outperforms and the full treatment, and even more so if it reduces the probability that consumers are inattentive by 30%. And on the right-hand side, same treatments. Yes.
Sorry to interrupt. That last result, could you point which bar is showing that one?
This is exchange with the same awareness. This is exchange reducing reducing the probability you are inattentive, right, by 15%, and this is reducing the probability that you're inattentive by 30%.
And then the 2 bars is
black
the treatment that you're doing for search friction change. Okay.
Yeah. So black is what or dark gray is assuming search frictions fall by 50%, and blue is assuming search frictions fall by 100%. That's right. And on the right-hand side, you've got interest rates, right? Refinancing is not necessarily the important outcome, but you can see the analysis is quite similar, right? The change in interest rates between the exchange and full treatment is basically identical. And if you change awareness, you also change average end of period interest rates. This happens because more people are refinancing, so the average interest rate at the end of the period must be lower mechanically. So it's essentially the same result. There's a little bit more heterogeneity analysis here that we think is interesting. I think the main thing is that high income borrowers seem to be the most marginal when you're reducing information frictions. They're the biggest winners here. So that's what we have for today. So I've shown you experimental evidence of the role of information frictions in the failure to refinance. We're finding that simple information treatments lead to increases in search behavior. We find no effects on refinancing, and that's likely explained by the increase in the interest rates. We do see that there's different pieces of evidence that point to biases in borrower beliefs about gains from refinancing as being the main friction here. I outlined a really simple model of demand and supply for mortgage refinancing. We show you that our simple email interventions improve outcomes, actually, as well as an exchange that doesn't increase awareness, but a little bit worse, I would say, than an exchange that also increases awareness. And what I didn't show you, but is in the paper, is that lowering these information frictions both increases monetary policy pass-through, but perhaps more interestingly, changes who benefits from interest rate reductions. So different informational treatments change the population of people for whom monetary policy pass-through actually leads to lower interest payments. The next steps is we're going to unpack a little bit more on the mechanisms using our survey data. We need to finish doing spillovers to the origination market, Like I mentioned at the beginning, we think that that's a really interesting thing to look at. We want to do more on distributional effects of these information policies. And we're considering trying to delve a little bit into contract design counterfactuals. So what would happen in counterfactual if you banned refinancing? Well, what would happen if you introduced counterfactual products such as one-sided adjustable rate mortgages, where when interest rates fall, the borrowing costs for mortgage borrowers also fall automatically, and this is just priced at origination so that surge costs and switching costs don't play a role. All of this requires, of course, the origination margin, which is why we haven't done it yet. But we think it's interesting to look at it. It's something that we hope to do for the next version of the draft. So that's it. Thank you very much for having me, and looking forward to your questions.
So Gaston, thank you. That was an impeccable use of time. We're right on just 1 minute late, which is rare. So thanks a lot for that. And we have enough time for questions and discussion. So please, you can unmute yourselves and ask the questions.
Maybe I'll jump in just to get people started. And Gaston, I'm sorry if I missed this. I asked you earlier if you wanted to speculate why refis are so much rarer in Chile than the United States. Did I miss that?
Yeah, I think it's a combination of financial literacy and lack of awareness. Like, I have not run our survey in the United States, but I expect that the density of the answer, I didn't even know that refinancing was an option, is going to be much lower. That's one. I think also there's less, government-assisted, government-subsidized mortgage options for borrowers who are just starting out in purchasing homes. Perhaps in the United States, that might induce an incentive for people who start in a loan that is particularly expensive, and then, as they become wealthier, they can refinance. People move less in Chile, quite a bit less than in the United States. And then there's the whole regulatory hassle, difficulty of getting offers, margin. It takes between 3 to 6 months to see this process through to completion in Chile. And my impression is that in the United States, that's much faster.
Mm-hmm.
Yeah.
And were your contacts at your the bank you worked with, were they surprised by the results?
So I'll say a couple of things. So the people that were the most interested in these numbers were the Chilean Consumer Protection Bureau, CERNAC. They were our main partners. They're the reason the experiment was run. They were interested because they were trying to push through regulation to reform the quarterly statement that consumers get. And they wanted experimental evidence on what the best quarterly statement was. This is how this project got started. So once the Consumer Protection Bureau got this hook, they did the difficult legwork of convincing the state-owned bank, you should allow us to go tell your customers to leave you, right? Which is it's never something a bank wants, right? So I'll start by saying I don't think the bank was super excited to be working with us, to begin with. I think that the results were the search results were surprising to them. They did not have a sense that this was going to happen, and the promise to the higher ups that sort of got this project to go through, to the higher ups at the bank, was that this reform was coming and they were going to be able to learn how to better deal with it much faster than their competitors. And I do think we delivered on that promise, because the reform is going to be implemented. There is going to be a new quarterly statement, and the bank now knows who's much more likely to search, right? So I think in the end, they were pretty pleased with it. Surprised, not so much. I think once interest rates spiked, they knew that not many people were going to be able to refinance. So it wasn't, that was the biggest emotion at that moment. It was just like, okay, yeah, it was going to be hard to find something here. Yeah.
Then I had a related question, because I think it's very interesting to learn a little bit more about the different in the context of the two countries, and especially because I suspect that these results that you're finding would also apply very much to the whole Latin American region, if not more. Normally, it is considered that Chile has the most advanced financial system and like higher levels of financial literacy and access. So I would only expect, these things to be looking even more dire in Bolivia and Colombia and other places. So, but my point was, do you find a big difference in the way the U.S., because U.S. banks advertise mortgage refinancing very aggressively. You get letter. I even before I had a mortgage, I would get letters asking me to refinance it, and so this is connected, of course, to the whole market structure. I don't know how competitive banks are, and if there's an unspoken agreement that that's not something you do, and you kind of mentioned just one aspect of it, like a large public bank where you were bringing in like pro-competitive measures and were not very well taken. So I don't know. Do you find private banks really trying to make people or advertise this possibility? And if you have some idea of the market structure and how competitive or concentrated it is?
Yeah. So the market is, in my opinion, less competitive than the United States. There's less advertising, fewer banks. So the market is much less aggressive to start. United States has brokers letting people gather offers from multiple sources. That doesn't exist in Chile. And especially for the poorest, not every bank that operates in the mortgage sector is involved in serving them. So while Banco Estado's share is 20%, over the entire country, if you do that as a function of income, Banco Estado is by far the dominant player once you get to sufficiently poor, and many banks just entirely drop out. It's not a monopoly. There is still competition. We do see many times in the pre-period banks responding to requests with offers that are much cheaper than the mortgage people have already, and we do observe switching. So it's not like it can't happen. It's always a little tricky to put a sharp number on how much more competitive one market is versus another, especially when you only have data from Chile. But yeah, that is my sense. For the rich, I honestly think that if you went and did the exercise of shopping, you would get quotes from everyone. And there, I think the demand side frictions are super relevant. Yeah.
In your model, so you find that this had heterogeneity, right? And then it wasn't clear to me. So in your model, you're not really microfounding this. It's more like you are using these elasticities of searching behavior to treatment that are different for different income groups to get different results, right? So it's the difference between the income groups are obtained from the field experiment, and then you just input those parameters in the structural model, right? There's no like underlying mechanism that would make in the structural model somebody with a lower or a higher income react differently.
Yeah, that's right. So in essence, we estimate everything through MLE. So it's not like we're in one step. So it's not like we're first estimating some parameters and then inputting them into the model, but rather all of these are estimated jointly by looking at the distribution of decisions consumers make as a function of their observables. But everything else you said, I will agree with. There's nothing in the model that forces high-income consumers to behave differently than low-income consumers. They could, in principle, behave the same. This is just what the data delivers. The data and the variation from the experiment delivers.
Yeah, I guess it's a different even paper, right? But like you have a very rich survey, and you say you're going to explore the mechanisms, and so it would be interesting to see if there's something going on other than just the information, like if it's like time, or these people would basically have to stop working to go into, but that's but
one thing
I'm
that's
just pointing
really
it out.
hard
It's a different
is,
paper, but it
Yeah.
seems to have all this very interesting information.
we have this issue in IO models that put in behavioral frictions all the time. It's like you have this behavioral friction, but what is it? So for example, for searching, is it time cost? Is it just I really don't want to search because it's a hassle? Can you tell me, how much of each of these forces contributes to the search cost? And that's hard. I think the best way to do this would be to design an experiment crafted at teasing apart different sources of a particular behavioral friction. But we decided that what we wanted to do was try to get at which of these frictions actually matters the most, rather than where does this friction come from, or each friction come from.
Any other questions from the audience? All right. So we're close to the 12:15 mark. I wanted to again thank Gaston and invite everyone in the call for our next seminar. It's going to be on Wednesday, February 15th, and it's going to be David Ling from the University of Florida, the Warrington College of Business, and he's going to be presenting catering and return manipulation in private equity. So we definitely look forward to seeing you there. Invite your friends and colleagues that are still not joining us. This is a great opportunity to get exposure and get to meet people that are in different places of the world. So thanks a lot for coming, and we'll see you next time.
Thanks again for having me.
Thanks, Gaston. Thanks, Luis.
Thanks so much,
Everyone.
Gaston. Thanks, David.
Mm.
This was great.